FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is May 13th, 2020. Real estate prices. Well, so far they're holding rather steady, but we don't really know because there has been a real market disruption. And now that states are opening up and people are able to look at new homes and think about the move, whether or not it's worth it, we're finally going to find out what's going on with the market. What do you think's happening with the market? Why don't you let us know? Email us kl@kerrylutz.com, kl@kerrylutz.com. We answer all. I've got like 100 emails in the queue. I will get through them this week, I promise. Well, our good friend John Grace is with us now. John, you're going to answer these questions and more. And real estate, it had some pretty interesting demographic trends in play. Now we've got 20 million people unemployed. What does that mean for the real estate markets?
It's a great question, Kerry. And I like to talk about the real fate of real estate. And what we've been taught, I would submit to you, is not the most fundamental piece of the equation that we should pay more attention to. We've been taught that real estate is all a factor of location and inventory and interest rates, things like that. And let's just notice in the early 80s, when interest rates were strong double digits, it had nothing to do with the need for people to buy a house. Where did that need start? Started with the baby boomers, 76 million of us. The U.S. is the only country in world history where 76 million people just came out of the woodwork into the equation. It's the first, and I suspect the last time this has happened in the U.S. So I think it's very clear, and certainly I would argue, that the reason prices today are at those lead levels is all as a result of 76 million people coming into the equation. Legal, illegal, legitimate, illegitimate, it didn't matter. You've got to have some place for these people to live, which means prices are going to respond to that kind of demand. So if we look at the Census Bureau and we look at Dent Research, we can see the pattern that most of us aren't recognizing. We're paying attention to the small indicators as opposed to the primary indicator. And I would submit that the primary indicator is looking at the buying and the selling behavior of Americans. That's number one, based on age. Number two, buying and selling behavior based on age. So we can see that most Americans historically have bought their first house at age 31. Looks like it's 37 now, so it's been slipping. But for boomers, it was definitely early 30s. And then they bought their biggest house age 41. So now everybody wants to know, where do we go from here? And we want to believe that we can't tell. Well, we can't see the future, but maybe we can tell. Let's turn on the headlights. Let's plug in the GPS. And guess what the next number is? Again, from the same sources, U.S. Census Bureau did research. We see, for most of us, it's the first time, that the majority of Americans sell their homes at 78. Mm-hmm. Now the boomers are 55 to 74. They're going through that door of beginning to come out of those houses, whether it's on their own volition or they're being carried out because they have passed away mid-80s, whatever it might be. But let's just look at it from this standpoint. We have, just as we've never seen 76 million people come into the equation, we have not seen 76 million people evaporate. And we're going to. So if we have 24% of the population, 76 million Americans, go to heaven, and the inventory for residential real estate stays the same from the last 130 years or so, where might prices go? Do you imagine they're going to hold or go up? I don't. I imagine they're going to go to hell, along with rental income, by the way, because the demand has just had this giant sucking sound over a 20-year period where all these people are gone. Mm-hmm. So I would submit that residential real estate, we've enjoyed that. Let's look to see where the next wave is.
All right. So, but we do have this millennial generation who right now is probably over indebted. Many of you millennials are out of work, but there are still millennials who are doing well, who are in a position to buy housing. Are they going to pick up the slack here, John?
Once prices come down, when I'm talking to clients with second and third homes, I'm saying, you know what, now might be the time to release that equity. When I'm talking to millennials, I will say this is not the 80s where by the time you closed escrow, you made money on the house because of all that demand. Notice if you told your parents, millennials, that they would see 3% money, they would laugh you out of their house. Well, we've got the 2.5% money on 30-year loans. Notice who's standing in line to buy a house. Nobody, nowhere. So millennials, I would say, complain about the rent prices. Complain about how you have to call the landlord to get the front porch light fixed. All right. Yeah. But keep your powder dry because you've not seen 76 million people disappear. And then if it is the case that you put your down payment down, you make the house as pretty as it possibly can, it might take you 2 years, and you don't mind your down payment evaporating just right before your very eyes, along with your payments for the last 2 years, 3 months, whatever the time frame might be, buy away. But if that might bother you, I would say don't buy a thing. And let's see where prices go, because I think prices are coming your way. Just be patient. This isn't the time to jump in and, fear of missing out. This is the time to just keep making the rent payments because, as I say, if the inventory remains the same and the population declines, it follows that prices will probably decline in a very big way.
I wouldn't doubt that you're correct. But on the other hand, American real estate is somewhat unique compared to the rest of the world, isn't it? In terms of its liquidity, the maturity of the markets and such. So how much can it really go down here? We keep hearing it. We saw it go down substantially in 08 and 09, but it came back, John. So why is this time different?
It was down about 34%. I would say that the reason that there was a stopgap in 08, 09, Terry, is because of the private equity programs, the businesses that came out of the woodwork with cash. They bought hundreds and thousands of houses without ever looking at them. That's not following the demographics. That's not an age-based decision. That's a business-based decision. They saw prices at an attractive level, and they moved in a very heavy way. Now, we also know they could move out at any time without missing a beat. All right? So, and then let's notice that when it comes to the U.S., we tend to have a lot of money in our real estate and some money in the stock market. The rest of the world, in contrast, tends to have really no money in any of the stock markets and all the money in the real estate. So what I'm trying to say is, it seems to me, it reminds me of the tulip bubble, right? 1634, where you could take one tulip in Holland and buy an estate, really. So everybody in the world has gotten high on these houses because it's the only way to get rich, and there's nothing else that works as well, and it never goes down. I'm just saying that all bubbles burst, and typically, by the way, when we study bubbles, what we find is from peak to trough, the decline is about 80%. Yeah. 80%. Who's ready for that possibility? And let's just recognize, who knows if that's going to happen? I don't, you don't, we'll see. But my real point is, as I say, for those who have a lot of equity or an extra house or two, if it makes sense to buy low stock and sell stock high, it makes sense to sell anything that might have appreciated beyond your imagination. Because if you don't capture the cash, it really doesn't matter. It's gone.
All right. But what about the concept that the Federal Reserve is reflating the currency and they're just going to keep printing money and reflate real estate yet again? Is that not valid?
Well, they're trying to do that. To some extent, that will not stop. And I would submit to you, I think I agree 100% with what you're saying. This premise of having the buybacks, the low interest rates, free money, everybody's gotten high on that as well. And let's just recognize that consumer debt is $2 to $3 trillion higher today than it was back in 2008. But again, don't lose sight of this whole thing that none of us has ever seen. And that's 76 million people disappearing. They're not being replaced.
Yeah, you don't think?
So whatever the government does, they can't affect the people who have passed away, who aren't going to buy anything ever again.
Yeah. Yeah, well, I see your point. Effectively, your argument is that demographics are destiny. That's That's the same with Harry, right? I mean, isn't that what we're talking
demographics
about?
drive a lot. It's something we never talk about. It's something we don't study. Yeah, I don't care who the student is or where they went to school. For the most part, we do not study demographics. And to put it in perspective, my baseline here is to just talk about potato chips, for example. 14 is the age at which most Americans ate the most potato chips. Did you know that? No, you didn't know that. But you did
except
that.
For me.
I know I did.
Except for me.
41 is the age.
Except for me.
You're the one exception. But oh, by the way, for the 41-year-old average American parent, 14 is the age at which their kids ate the most potato chips, and they bought the most potato chips in life.
That I believe. And I will tell you the trend. It's so fascinating, John. That like I could do a whole show or a week of shows on demographics because, like you say, it's so ignored. And I know for myself, in your 30s and your 40s, building a family, you're in your acquisitive phase, maybe into like 54. And then like magic, it just stops. I will tell you, I still buy a lot of junk. Yeah. But not anything
you
like
do, but it's
then.
Optional. Yeah. When you have the kids, you can't make enough. You can't spend enough. Now, to your point, here's another little piece of the puzzle that nobody's recognizing because, we got to take care of this. We need that, political party out. We need this one in. No, let's recognize this little factoid. And that would be that globally, we suddenly have more people aged 65 and older than 5 and younger.
Yeah. That's good for nursing homes. It's great for nursing homes and assisted living.
Nursing homes. Yeah. Hallelujah. So when we're talking about real estate, for example, that's my point. Maybe we should get out of the rental real estate and get into the healthcare real estate, be it liquid or illiquid, because 10,000 people a day are turning 65 through 2030. Yeah. COVID-19 is not going to change that if we're still here. Okay?
Well, they're trying. Actually.
Well, it might. It might be successful, but not on my watch. But you see what I'm saying? If we got to look at are these tailwinds making it more difficult for us to get to our destination, or tailwinds making it easier, or headwinds making it more difficult to get to our destination? So I'm saying that the wave for residential has crested. Now let's catch the next wave elsewhere. And if it's going to be real estate, and by the way, Kerry, when I go back and look at how healthcare related real estate, again, whether it's liquid or illiquid, 2008, it wasn't hurt much.
No.
And it responded the fastest.
Assisted living is
I think that's going to happen next time.
And maybe converting.
It's so huge. It didn't get smaller.
Maybe converting existing residential to assisted living and 55 and over communities. And one other industry that will definitely be a beneficiary of this is the straw industry, because there's going to be a lot of people having their food through straws, right?
Yep. Yeah.
Bad joke, I know. Bad joke, I know.
Well, it's okay. But I mean, look, we all are familiar with the stock market after the Great Depression dropping 80%.
Sure.
Hardly anyone, particularly the real estate professionals, have any recognition that New York real estate, always a fine city, dropped around the same time, approximately 70%. 70%.
I know.
And how long did it take for them to get back even? Only 4 decades. That's 40 years. Yeah. So my point is if that happened before here, and by the way, it's happening right now in Japan, so we have 2 examples of this recovery that never fully recovered. Could something like that happen again here?
I'll tell you exactly where it's happening now, John, exactly where it's happening now. I know this for a fact. Okay. In Westchester County, New York, and in Nassau County, New York, people built these big McMansions, and there's nobody to buy them because the millennials can't afford it, and the millennials want to be more urban-based, although after COVID-19, that could change.
They don't care for the crown molding. Yeah. They don't need 16 rooms.
Yeah, they don't want to clean it. They don't want the Sub-Zero refrigerator, and they don't have the money. Right. And so they're going to have to subdivide these McMansions or do something or turn them into assisted living facilities if they ever hope to sell them, right? And then they have stairways. 100%. They don't generally have elevators. They're multi-story. They're just not going to work unless they put in a big elevator. But I know my friends, like I said, I'm getting out of New York. I'm getting out of the big house. I'd already had one big house, sold it, got a smaller house, which I preferred greatly. A lot less things to smaller the house, the less things to go wrong on it. And then sold that, moved to Florida before the rush really hit. I mean, you look at your demographics, and the older you are, the less you like colder weather as a rule. So you're going to move to warmer climes, right?
Yep.
So that would kind of indicate that real estate southwest in and also you look for lower tax jurisdictions. People have been moving to get away from high taxes in New Jersey, New York, Connecticut, Massachusetts, to Florida, to the South for over 50 years. Yep. And that trend has only been exacerbated and was way exacerbated by the new tax law, right? And we can only look forward to more of that, right?
FSN Radio. It's all about what's next.
Financial Survival Network is brought to you today by Orin Resources, a junior exploration company with the appetite of a major. It's hot on the trail of the next globally significant discovery, creating enormous potential upside for you, the shareholder. Orin is one of the most aggressive exploration companies pursuing high-grade, scalable gold and copper deposits, and has a premier 7-project portfolio, including its 2 flagships, Committee Bay in the Arctic and Sombrero in Peru. Orin's unparalleled technical team and highly experienced management has a history of success in advancing and monetizing exploration assets. No wonder Orin's been called one of the best in the junior exploration sector. Orin trades on the TSX and the NYSE under AUG. To learn more, go to orinresources.com. That's AURYN resources.com.
The Financial Survival Network. It's all about what's next.
Yeah, I mean, more of that, 100%. I mean, I would say to you that if you ask me what kind of declines do you imagine might happen, I would say, not too bad for Cleveland, maybe 13%. But when it comes to the coast, it might be 50% for the East Coast and 60% for the best coast, the West Coast, okay? Yes. Because they've gotten way out of whack. I mean, I think the median household income, last I looked, it was something like $250,000. And you look at the prices, like you say, in New York and here in California, clearly it's $1 million house is just ordinary. Yeah. And you need to have, remember, not too long ago, you could buy a house and figure that it would cover, your income needed to be, the payment needed to be a third of your income. Now the payment's 5, 6, 7, 8 times your income just for the freaking payment. Nothing to do with the repairs or the improvements and all of the, things that you forget to have cash for that suddenly, like you said, the bigger the house, the bigger the expense.
Yeah, that's so true. And we see it over and over and over again. There's nothing new under the sun, and we all know that. Well, also in Florida, though, we've got inflated markets in Florida too, like Miami, all these multi-million-dollar apartments, $1 million to $3 million to $5 million. The taxes on them still have to be paid, even though the mortgages can't be. And these mortgages were made by hedge fund subsidiaries. So we got a crash coming.
Well, and I mean, if you look at the Great Depression, there was no financing. So to the extent that people lost their houses, it wasn't because they couldn't make their payments. It was exactly what you're talking about. It's because they couldn't make the property tax payment.
Yeah. Yeah. And it's 2%. 2% is low by nationwide standards. Some states are less, but 2% is a good rule of thumb. But 2% on $1 million assessed property is $20,000. On a $3 million, it's $60,000, and
that's a whole lot of money.
Yeah, and that goes with the mortgage payment as well. So you have to be very choosy. You got to be picking the real estate that the future retired elderly boomers are going to want to live in and can afford to live in, and really, you got to get rid of that house now. Find the greater fool for your house, because the greater fool might not be there tomorrow.
Yeah, I mean, it'll be interesting to see what happens here. But I think what's going to happen is on a global basis, people are going to wake up. I mean, we live in a nice community, and it's not uncommon for people to drive an hour to town to work and then back to the suburbs. Okay. And the kids of those parents looked at the parents going, "You're crazy. I'm not doing that." Yeah. They don't care about this big ass house. Okay. So I think globally, the majority of people will come to the conclusion, this real estate thing, it's more costly than I ever imagined. So maybe we keep this house small, kind of like Warren Buffett, and we make sure we got $2, $3, $4 million outside the house so that we can live wherever we want to, the way we want to. But if we put all that money in the house and we're never able to use it, and then we've got all these unforeseen expenses that come up and we need money for immediately, it's just not fun. Let's do something else. It's kind of like, what in the 60s and the 70s, mom drove a Ford Country Squire if mom was cool and lived in a nice suburb. The children of mom are like, "Are you kidding me? I'm not driving that." Yeah.
Oh, yeah. The Vista Cruiser, the Oldsmobile Vista Cruiser. That was the coolest one. It had the windows on the roof.
That was the coolest one.
Oh, yeah.
Right.
Yeah. My friend's mother had one. It was great. Yeah. And it had sun visors right by those little windows, too. Well, I see your point. I think there's a lot of validity to it. The increase in housing prices were largely demographic driven up to the 80s and then even the 90s. But now the other end of the demographic curve is rearing its ugly head. It's a parabellum. Yes. Right? It's a parabolic market.
100%.
But it happens in slow motion.
Well, that's precisely right. And you're so busy in the middle of the herd, you don't recognize that you're part of the herd. But exactly to your point, from 1980 to 2000, if I'm not mistaken, 40% of all the homes purchased over that 20-year period were on lot sizes of 1/2 acre to 10 acres in size. Yes. Really? Yeah. That's exactly the boomers buying those McMansions wherever they can afford them, thinking they're doing something unique and sweet for their families, and they're doing exactly what everybody else can do because they're making the money, and let's get the big house so we can show off the big house. Now we look at these houses going, "Gee, I may never have anybody over again. What the hell do I need with a big house?"
Yeah, well, the whole big house thing was just inherently wasteful, costly, and predicated that there would always be a market for these McMansions. And as we've seen in Westchester County and in Long Island, New York, the market has somewhat dried up. The values of these homes have gone down. I look back, I got out in 2012. And you know what? No regrets. Well, anyway, John, I know people out there are going to want to find out more about you. Where is the best place to track you down?
Our website, Why Be Poor, as simple as it sounds, WHYDEPOOR, whybepoor.com.
And there's a link to it in the show notes to this interview on Financial Survival Network. I want to hear your opinion. Where are you stuck? Are you stuck in a McMansion that you'd like to get rid of, but there's no market for it? Email us, kl@kerrylutz.com. Don't forget our Twitter feed, @KerryLutz. Our Facebook page is Financial Survival Network, and our website's financialsurvivalnetwork.com. Sign up for a free newsletter going out in the next day or so. John, always a pleasure. Thanks for bringing that perspective of residential real estate to us, and we'll just have to see how bad it gets.
Stay tuned. Film at 11. See you next time, Kerry. Always a pleasure.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.